I'm going to start this video by arguing against myself. If you put your money into a global stock market fund, you can earn around 8 to 10% a year. No tenants, no repairs, no phone calls at 10 at night. You press one button, you never think about it again, and history says you'll do very nicely. So here's the honest question. Why would anyone bother with property? All that hassle for an asset that on paper grows more slowly? It's a brilliant question, and there's one word answer that changes everything: leverage. By the end of this video, you'll understand why it's the single biggest advantage in property and why, honestly, I wouldn't invest in property at all without it. I'm Kaylee, the Yorkshire Property Sourcer. We help busy professionals build hands-off property portfolios, and this is a video I really wanted to make because leverage is the most powerful idea in property, and it's the one most people never have properly explained to them. Get this and you'll never look at a house or your own money the same way again. One quick ask before we start, and it's the only one. If you get something out of this, subscribe. It's genuinely the single most useful thing you can do for a small channel like ours, and it's what lets us keep making them. Right, let's get into it. Let me be completely fair to the stock market first, because I mean this. Over the long run, a global index fund has returned somewhere around 8 to 10% a year. Now that's before inflation. Strip inflation out and the real figure is closer to 5.5% a year. But still, that's genuinely a good return. It's completely passive. You can sell it in seconds and it spreads across thousands of companies around the world. Property on the raw numbers doesn't beat that. UK house prices have grown at roughly 5% a year over the long term. Slower than shares, more hassle than shares, less liquid than shares. So if the asset itself grows more slowly and it's more work, how on earth can property produce bigger returns? Because you're not really investing the way you do with shares. With property, you get to use something almost no other investment allows. You get to safely borrow most of the money, and that one difference changes the entire game. Let me show you exactly what leverage does. Imagine a property worth £200,000. To buy it, you put down a 25% deposit. That's £50,000 of your money. The bank lends you the other £150,000. Now here's the magic. You've put in £50,000, but you control the whole £200,000 asset, and every penny that asset grows is yours. Watch what this does. Say the property goes up by 5% in a year. 5% of 200,000 is £10,000, but you only put in 50,000. So that £10,000 gain is actually a 20% return on your money. The house went up 5%, your money went up 20. That's 4 times the growth of the asset itself. And it happened because the bank's money was working for you on the part of the house you don't even own yet. That's leverage. You put in a quarter, but you get all of the growth. And no stockbroker on earth will safely let you do that with shares. I'll come back to why that word safely matters so much. Now we get to the part that almost nobody talks about, and it's my favourite because it's so quietly powerful. Inflation. Everyone thinks of inflation as a bad thing, the enemy, the reason everything costs more, and for your savings it is. But when you owe a fixed debt, inflation becomes your best friend. Here's why. When you take out a mortgage, the amount you owe is frozen. If you borrow £150,000, that number never grows. But every year, inflation makes everything else more expensive. Wages, prices, rents. So slowly that fixed debt starts to feel smaller and smaller compared to everything around it. Let me put real numbers on it. At normal levels of inflation, a £150,000 debt today is worth around £6,000 in today's money after 20 years. You still owe it on paper, but in real terms, it's what it can actually buy. It has shrunk to nearly half. Inflation quietly ate it while you slept. Think about that. The asset grows, the debt shrinks in real terms. You are being pushed forward from both ends at once, and you didn't have to do a thing. And it gets better because there are 2 more focuses working alongside it. The second one, the value of the property itself rises over time, broadly with inflation and often above it. So the very thing that's shrinking your debt is lifting the value of what you own. And the third one, rent rises too. Historically, rents have gone up roughly in line with inflation over the long term. But here's the beautiful part. If you fix your mortgage, your biggest cost stays flat, while the rent coming in keeps climbing. Picture that gap. Year one, the rent covers the mortgage with a bit left over. But 10-15 years later, the rent has climbed and climbed and the mortgage payment has stood still. Your income grows every year while your biggest cost is frozen in time. Debt shrinking, assets rising, rents climbing. Three engines all running at once, all powered by the same inflation everybody else is complaining about. Now, two things that make properties leverage genuinely unique, and this is the bit I really want you to remember. First, who's actually paying that mortgage? Not you. Your tenant is. They pay the rent pays the debt. So you've borrowed £150,000, inflation is shrinking, the asset is growing, and someone else is clearing the loan for you. There is no other investment on earth where a stranger pays off your borrowing. And second, the big one, safety. You might be thinking, well, I could borrow to buy shares too. And you can, but here's what happens if you do. If you borrow to buy shares and the market falls, your broker can force you to sell immediately at the worst possible moment to pay back their loan. It's called a margin call and it has wiped people out. Now compare that to a house. If the house prices fall tomorrow, does the bank ring you up and demand their money back? No. As long as you keep making your monthly payment, nobody can force you to do anything. You just hold on, keep collecting the rent and wait for the market to recover, which historically it always has. This is the whole thing right there. Cheap borrowing that a tenant pays off, that can't be pulled out from under you. Shares can't offer that, almost nothing can. So let's put it head to head. Two people, £30,000 each. Person one puts their £30,000 into a global index fund. Sensible, diverse, completely passive. At a healthy 8% a year, after 10 years, that's grown to around £65,000. They've roughly doubled their money. And honestly, that's quite a result that took zero effort. Person two uses their £30,000 as the deposit and cost on a £90,000 terraced house in Goole, the kind of deal we find on the ground right now. Same 10 years, the house grows at a conservative 5% a year, so it's now worth around £145,000. That's £55,000 on growth on an asset that only put £30,000 into. And all the while, the tenant's been paying rent. After the mortgage, that's around £470 a month. Another £56,000 over the 10 years. So person two is sitting on over £110,000 from the exact same £30,000. And remember, we haven't even counted what inflation quietly did to their mortgage in the background. Same starting money, one doubled it, the other more than tripled it and got paid every single month along the way. That, in one example, is leverage. Now, I promised to be honest with you, so here's the other side, because leverage is powerful and powerful things deserve respect. Leverage magnifies everything. It magnifies your gains, but it magnifies your losses too. If prices fall, you feel that on the whole asset, not just your share of it. If your interest rates jump when you come to refix, your costs go up. And we saw exactly that happen to landlords who hadn't planned for it. And if the property sits empty, the mortgage still has to be paid. So leverage is not a toy. But here's the thing, every one of those risks is manageable. And it's manageable in the same way. You buy below market value, so you start with a cushion of equity built in. You stress test the numbers so the deal still works even if rates rise. And you keep a buffer so an empty month or a repair never becomes a crisis. That's the entire discipline. Respect the leverage, buy well, leave a margin of safety, and it becomes the most powerful wealth building tool available to an ordinary person. Ignore the rules and it bites. The tool is the same, the difference is how you use it. One last thing, and this is what the serious investors understand that most people don't. The cheapest borrowing you will ever have access to in your life is the money secured against your own home, because the bank sees your home as safe and they lend against it at the lowest rates going, far cheaper than a personal loan, a credit card, anything. So what do experienced investors do? Many of them release some of the equity from their own home and use it as a deposit to buy investment properties. They're taking the cheapest money available and pointing it at an asset that pays them back. That is leverage on leverage, and it's one of the quiet engines behind a lot of property wealth. Now, I have to be clear because this matters. Your home is on the line when you do that. The rules are strict and it's not right for everyone. So this is not advice, it is simply how it works. If it's something you'd ever consider, speak to a good qualified mortgage broker who can look at your situation properly. So let me bring it all home. Property doesn't win because houses grow faster than shares. They don't. Property wins because you can safely borrow most of the money at cheap rates that a tenant pays off. That can't be called in while inflation shrinks your debt and lifts your asset and your rent all at the same time. That combination that doesn't exist anywhere else. Worst case, you treat leverage carelessly and it punishes you. Best case, you respect it, buy well, and it quietly builds you a level of wealth that saving alone never could. By the way, if you'd like to see exactly how we help investors put all of this into practice, the towns, the numbers, the whole process, I've put together a free investor pack and the link is in the description below. And if you found this useful, subscribing takes a second and genuinely helps us keep making them. This is Kaylee, the Yorkshire Property Sourcer, helping you invest in property the right way. I'll see you in the next video.